Hey friends, Keith Collins, Market Leader Movement Mortgage. Hey, I just wanted to do a quick video here to share a little bit about what's going on. My purpose is to explain actually what's happening and why it's happened, and then to set proper expectations about maybe what's to come in the future if you're involved in a real estate or refinance transaction. What's happened? About 2 weeks ago, mortgage interest rates dropped almost a full percent, in some cases 1.5%, in a very short window. About a 4 to 8 day period of time, interest rates dropped that quickly. And what we saw was an absolute frenzy in the mortgage industry to initiate a refinance for customers to save money. Traditionally, the mortgage industry does about $2 trillion in loan volume every year, and they're estimating anywhere from $5 to $8 trillion in refinance opportunity for customers to save money in that low rate environment. So during that period of time, the stock market shed about 30% of its value. So banks and companies and investors pulled a significant amount of money out of the stock market, and the stock market dropped about 30%. What we typically see in a stock market drop is we see bonds, mortgage-backed securities, and mortgage interest rates benefit from this. But what's actually happening is a lot of banks were actually having to raise capital, and so they were selling assets, and then they were also selling treasuries, and they were selling gold to bring additional capital into their system to be able to fund this refinance opportunity. Essentially. And so it was kind of an opposite reaction. We would see the stock market come down, we would typically see interest rates get better, and that just didn't happen. It actually was the opposite direction. And then interest rates went up. And so we actually had interest rates give back all of what we gained really last week. And so, and in some cases, interest rates were a little bit higher. And then we had Sunday, and the Federal Reserve did a few things. So Sunday, the Federal Reserve did an emergency meeting, and this was significant because they had a meeting scheduled on Tuesday. So for them to make monetary policy on Sunday, they're a little concerned, and they needed to make significant change, and they did a few things. One of the things they did was lower the federal funds rate to 0. Now I want to explain this because we get this question a lot, and it's common, you know, it happens. We have people think that their mortgage interest rate is now going to be 0. That's not the case. What the federal funds rate is the rate at which banks exchange money to each other overnight. This impacts things like auto loans, credit cards, and home equity lines of credit. So on your next credit card statement, you might see a lower interest rate, about a percentage point, because of this drop. You know, if you have an auto loan and you had maybe you got that auto loan a year and a half ago, it might be an opportunity for you to take a look at your auto loan interest rate and maybe save money, because those rates should be lower. But that rate drop doesn't have a direct correlation to mortgage-backed securities and mortgage bonds. They're similar. They're kind of like second cousins, right? It's familiar, but really, you know, there's nothing in common there. So they also started again something called quantitative easing, and that was something that they did a few years back to get us out of the mess that we were in, and potentially keep interest rates lower. And so they committed about $750 billion of quantitative easing. That's not going to be injected right away into the markets, but that's going to be injected over time, and that should actually bring interest rates back down. That's the hope. And with that, we should potentially see a low rate environment again. Now, I want to set proper expectations. I mean, interest rates right now, they're back in the mid 3s on 30-year fixed stuff, and in the low 3s on maybe some government stuff. And that's actually a pretty big drop today from where it was last week. But that's like historically low interest rates. Even if interest rates were still in the 4s, they're still historically low interest rates. But this also presents a little bit of opportunity, but also a problem. And the problem is capacity. From an industry standpoint, we're over capacity. You've seen banks like Wells Fargo, and I don't mean to pick on them, it's just a thing. They've raised their interest rates all the way up to 4.5% in a market that should show lower rates. And what they're basically saying is, hey, we need to slow down the influx of business. It's too much for us right now. So if you're thinking about a refinance and maybe trying to chase a slightly lower interest rate, I would say two things. One, don't be greedy. If there's an opportunity for you to right now lock in something that benefits your family, and is it a make sense opportunity? See, I think clients often mismanage the opportunity in a refinance. And I think right now, if we take advantage of the opportunity and restructure debt or potentially save money, the question is what are we going to do with the savings? And if that savings provides a significant impact to us and our family, it might make sense. If the interest rates right now don't make sense, one of the things that we're talking about with customers is get everything together, get ready, get positioned, right? Let's do the application without pulling the credit report and get all your financials and documentation in place. And if interest rates drop again, let's go ahead and take advantage of that opportunity. So I hope this answers questions. Please, if you have more, I would love to help. Please reach out. It's Keith Collins, Movement Mortgage. Have an absolutely blessed day.